Good morning. You're watching the live daily outlook for majors prepared by Wenza Brokers for Tuesday, 11th of October 2011. The positive sentiment in the markets persists after yesterday's strong rally supported by Franco-German meeting on Sunday, when the decision was made to take the bigger and stronger measurements in order to shore up the banks, to settle the Greek crisis, and to help growth in Europe. After the Sarkozy-Merkel meeting, the strong signal was given to the market, and the strong rallies recorded on stocks, commodities, as well as some major currencies such as euro and sterling against the dollar, and hitting some very important resistance levels, most of the instruments actually. This positive tone actually keeps remains after yesterday's strong rally, where euro actually registered the strongest growth in past 15 months, gaining over 2% on a rally to test initial and stronger resistance at 137. The European Union actually yesterday postponed the summit by 1 week to allow time for a broader solution to Greece's debt crisis, after Athens said it had concluded talks with international lenders on an aid payment needed to avert default. So this positive sentiment is still on, and the current corrective trading is on most instruments is seen as a consolidation of the recent gains, and the positive sentiment sees scope for a further extension higher, especially on euro and the cable, as well as gold and crude oil. That will later take a look on our technical part. Some disappointing news coming from UK, that saying that UK's economy barely grew in the third quarter, as today we have the GDP estimate for the third quarter of in UK, and the risks facing its fragile recovery are growing due to worries about the eurozone debt crisis and global demand. The British Chambers of Commerce, which represents companies employing 1 in 6 UK workers, said its quarterly poll showed a disturbing domestic decline and the worst conditions for exporters since the recession in 2009. The Business Lobby Group said that Britain's coalition government must take urgent steps to stop the economy from tipping back into recession after 12 months of stagnation. From today's calendar, as mentioned earlier, at 1400 GMT, it's the UK Q3 GDP estimate. Before this, 12:15 housing starts in Canada. And at 8:30, so in approximately 20 minutes, we have a batch of data from UK manufacturing production. Expected today's forecast minus 0.1, expected to decline from 0.1% previous release. Industrial production on monthly basis also expected to stay unchanged from the previous month, 0.2% previous month release, with today's forecast at minus 0.2%. Earlier during the night, the current account in Japan showed 0.657 trillion yen positive, higher than 0.517 trillion, 0.51 trillion forecasted. Let's take a look on the technical outlook for majors and the commodities for today. Euro extended the gains after yesterday's break through the main short-term trendline resistance from 139.35, which is the high of 15th of September, clearing 135 and 135.23, the high of last Friday, and extending gains to briefly break above 136.89, the previous high of 28th of September. and also the 136.79, which is the 38.2% Fibonacci retracement of the broader downtrend from 145.48 down to 131.45. So the break here actually is required to signal fresh leg higher and open levels on the upside at 137.96, 21st of September high, ahead of 50% Fibonacci retracement at 138.45, and then in the short term we have the key barrier at 139.35, 15th of September high. Current easing is seen consolidative and corrective so far, with the dips holding above 136 initial support and the round figure support, with the 20 days moving average hovering around the price currently. It might signal some further consolidation ahead of fresh rally higher, as the hourly studies remain positive and regaining momentum currently. The current pullback was also seen on the overbought hourly conditions, so further easing down to 135.23, 135.00, which is our initial and strong support, should be, it's possible to be seen ahead of fresh rally. However, the 135.00 needs to contain in order to maintain immediate bulls for a fresh rally higher. Loss of 135 would allow for a stronger correction of the recent 131.45, 136.97 ascent, while the key support remains at 133.60 low of last Friday, and the loss of this level would turn the near-term outlook bearish. On the daily outlook, the immediate tone maintains bearish structure, however started pointing higher with the additional support given by yesterday's break above 20 days daily moving average, signaling some stronger recovery. However, the overall tone remains bearish while holding above 139.35 and 140.50, where the 200 days moving average currently stands, with break also of 55 and 20 days moving averages below 200 days, signaling further weakness of the pair. From British pound extension yesterday to test 156.87, just ahead of 157.00, 157.14, our key short-term barrier. The positive sentiment persists, and we can see that the shallow correction followed down to the levels above 156, with the current strength underway, currently attacking at 20 days hourly, 20 days moving average. Clearance of 157.14 is required at this point to resume the recent recovery from fresh 14-month low at 152.71, and possibly hint the forming of double bottom ahead of stronger recovery. Next level is Fibonacci 38.2% of the broader downtrend from 166.17 down to 152.71, and currently stands at 157.85. So in case of clear break above 157, which is our key short-term barrier, 157.14, opens Fibonacci 38.2% retracement at 157.85, and then we have 158.65, the high of 15th of September. On the downside, the near-term initial support comes ahead of 56, 155.80, while losses below 155.25, 155.00 would be risky and actually would turn the near-term outlook more bearish. The daily outlook, similar to Euro, remains firmly bearish. However, some signals on after breaking above the trend line and 20 days moving average might hint some stronger correction higher, with the break of 157.14 required to confirm this. Dollar yen remains within its narrowing range. However, the tone is slightly more turned to the downside after losing the initial support from 76.09 low, and with 76.50 zone currently holding the downside, and the immediate barrier on the upside comes at 76.90, 77, where also lies the bear trend line drawn from 77.85. Basically, clearance of 77 barrier on the upside, which is also the trend line resistance, is required to hint some movements out of the current range. And actually, where we see the forming of a triangle here with break of either side, clear break of either side to signal the fresh direction of the pair, and the open way either on the downside for test of 76.10, 76.00 and 75.93, the record low, or on the upside above 77 opens 77.25, 77.85 and 78.00, break of which is required to confirm the fresh upside direction of the pair. Dollar Swiss is still heading south in its corrective movements from 93.10 high of 6th of October, with the bearish divergence seen on the 4-hour chart. We can see on MACD the bearish divergence signaled this actually corrective easing. Loss of 92 and 91.40 initial supports so far being contained, but by 90 zone. However, the scope is seen for a further easing as the near-term studies are below their center lines, and the likely scenario would be test of the key support at 89.20, which is the previous high and the previous low of 29th of September, and the loss of this strong support level might signal some deeper correction of the pair, as we can see that the stronger uptrend from 70.67 has retraced between 38.2 and 50%, close to 50% of the broader downtrend from 117.30 high of 2010 down to 70.67 low of 2011, and also the record low of dollar Swiss. On a loss of, as I mentioned, loss of 89.20 support, would likely open way for test of the 200 days moving average that is currently slightly below 88 zone, and break here to put short-term bulls on hold in favor of stronger pullback. On the upside, the initial barrier comes now at 91, 91.40, which was the previous support, while clearance of 92.78 and 93, 93.10 is required to open the extension upside and the exposed levels at 93.38 and 94.00. Commodities, some significant movements on gold, as the yellow metal is attempting now through our initial barrier, the recent consolidative range high at 1679. So far 1683 was seen, so there was a brief break above. There is also the Fibonacci 38.2% retracement at 1678, 1679, the same level. The Fibonacci retracement of the broader downtrend from 1920 down to 1532. Also significant on the daily chart is a lift above 90 days moving average that was recently capping the upside attempts. We need to see the clear break of 1679, 1680, sustained break above here, which will first face 1692, the 20 days daily moving average, in order to signal a stronger recovery of the bounce from 1532 low posted on 26th of September. For now, the daily studies are still in the bearish tone. However, some improvement was seen as the 200 days moving average holds the downside of break of 90 days moving average, but clear break of 20 days below 55 days daily moving average might signal still a weak tone. However, clearance of 20 days MA break higher would open way for a stronger recovery. On the upside, we have 1700 as immediate barrier and strong resistance, above which to open way for 50% retracement at 1725. The crude oil is also in the strong corrective mode, clearance of 84.70, 84.00, 84.75, and break, brief break above 85.00 resistance zone maintains the recent short-term positive tone of 74.94 low of 4th of October. With immediate target on the upside at 87.09, the main trend line resistance from 114.80. The high posted on 27th of 3rd of May to 2nd of May 2011 would break here to signal some stronger recovery. However, a clearance of 90.57 is required to end this consolidative, I would say, phase of the broader downtrend and the signal double bottom here ahead of stronger recovery. On the near term, the gains are currently supported with studies well above their midlines, and the current corrective pullback on overbought 4-hour and hourly charts seen underway. 20 days moving average on the 4-hour chart offers support at 83.20 currently, with next support at 81.36, which is expected to contain the pullback in order to resume the recent rally. Fundamentals are also still quite supportive for gold and for crude oil, as current positive news from Eurozone and the strong steps taken by French and German officials are bringing hopes back for a further recovery and avoiding the worst scenario of bankruptcy of default of Greece, and then further harming the Eurozone. So basically the positive tone that persists from yesterday keeps the commodities in the direction north, and some clearance of some important levels opens way for a stronger recovery.